Good morning, students. I, CA Ashish Gupta, welcomes you all in this session on the live virtual classes batch 2 for the paper Advanced Financial Management. And the topic is Financial Policy and Corporate Strategy and Risk Management combinedly. I, CA Ashish Gupta, Joint Director Board of Studies, welcomes you all in this session. Now, student, as this is we are recorded because we are presuming that you have must have referred the recorded lectures. So we are basically in this session, today's session, what I will do, I will take you to revision type of session for these two topics, and also I will take your queries in this session. So student, in a first 2.5 hours, I will cover briefly all these two topics, and after that, in last half an hour, all the students will be the session will be open for them, and they can raise their queries and by even by the audio also. So students, let us start discussion on this topic. Now, when we talk about, first of all, when we you have must have gone through a lecture. In our first lecture, we have basically given an overview of the syllabus. Now, student, why the syllabus is important? Syllabus is important because it forms the basis of your examination. Because paper setters are given the syllabus first. There is the first thing that they are given for setting up a paper is a syllabus. स्टूडेंट्स जो हमने ओवरव्यू दिया हुआ है पहले चैप्टर में, वो उसका पर्पस यही है कि आपको पता होना चाहिए कि आपका सिलेबस क्या है. एंड स्टूडेंट, वन मोर इम्पोर्टेंट, इन माय लेक्चर आई मे बी यूज सम हिंदी, बट प्लीज स्टूडेंट हु आर फ्रॉम not Hindi background, please try to understand whatever I will cover in Hindi, I will already covered in English, or I will cover in English after the speaking in Hindi. So don't worry, nothing will be left untouched that I have covered in Hindi. तो स्टूडेंट, वेरी इंपॉर्टेंट, अगर हम इसकी बात करते हैं सिलेबस की, सिलेबस इसलिए इंपॉर्टेंट होता है कि पेपर सेटर्स को वही पहली चीज दी जाती है जिससे कि वो जिनके बेस पे पेपर सेट करते हैं. तो ओवरव्यू, हम जब सिलेबस की बात करते हैं, what is our objective? First of all, the objective is to apply the financial management theories and techniques in the strategic decision making. Now student, अगर बात करें हम इसकी, अगर आपके सिलेबस की, तो ये सिलेबस जो आपका है एक तरह से एडवांस फाइनेंशियल मैनेजमेंट अगर हम देखें तो एक ये वर्जन बनता है आपके पिछले सिलेबस का जो आपने इंटरमीडिएट लेवल पे किया है. Now student, when we talk about this topic of advanced financial management, we can say it is a kind of an extension of the paper on financial management that is covered at intermediate level. Now, in the intermediate level, you are basically updated yourself, or we can say you have gained the knowledge about the what is the basics nitty-gritties of the financial management. Now, if I talk about way back in 1980s, 80s and 90s, so because the topics that today we are discussing in this syllabus are new topics. In early 80s and 90s, in the CS syllabus, the topics covered in financial management were at a final level. So at the time, the market was not so much dynamic. India's economy was not so globalized. So of course, with the these topics were suitable for making the decisions, and these were can be used by CFOs of the companies to make the decisions. And because since the chartered accountant role quite limited up to auditing a traditional role, so these topics were very simple and very basic. But with the passage of time, the role of the chartered accountant has become increasingly manifold. They are not only required to take care of the you can say traditional role of auditing, accounting, and taxation. Now they are looked upon as caretaker of the finance also. Okay, they are being started involving in the decision making process, strategic decision making process. So accordingly, our first chapter is basically, as we have seen, the financial policy and corporate strategy. Now here in this, the role of the chartered accountant has been started. So with this, the new topics has started emerging in our syllabus. स्टूडेंट्स, अगर हम बात करें पहले की, तो पहले जो हमारा पेपर का बेसिक होता था, जो आप इंटरमीडिएट में फाइनेंशियल मैनेजमेंट पढ़कर आए हैं, वही पेपर का टॉपिक्स होते थे आपके फाइनेंस लेवल पे. तब तक इंडिया फाइनेंस इतना डेवलप नहीं हुआ था, ना ही इंडिया की इकोनॉमी इतनी ग्लोबलाइज थी. बट विद द पैसेज ऑफ टाइम इकोनॉमी ग्लोबलाइज हुई और अब उसका दायरा बढ़ा, और अब चार्टर्ड अकाउंट का रोल नॉट एक ट्रेडिशनल रोल से बढ़कर एक फाइनेंस का फाइनेंशियल यू कैन से फाइनेंस को देखने वाला रोल भी बन गया, तो इसलिए उसका रोल बढ़ता गया और नए टॉपिक्स आते गए। तो अगर हम पहले टॉपिक की बात करते हैं अपने सिलेबस में, तो वो टॉपिक वहीं टच अपॉन करता है। नाउ व्हेन वी टॉक अबाउट द इंट्रोडक्शन, जस्ट आई विल स्टार्ट राइटिंग। फर्स्ट ऑफ ऑल, our if we see our overall syllabus is divided into 6 sections. Okay, student, it has been divided into 6 sections, and different weightage has been allotted to them. Okay, now when we talk about first section, the first section of the syllabus starts with the this topic, that is our financial management and corporate strategy, and in this our topic start with the advanced role of CFOs. Okay, if you see the chapter in the study material, and student, I hope you must have using this study material. Okay, because this is a study material, this is the base of your preparation. So you must be using this. So this topic starts with the exploring the role of role of a advanced role of a CFO in today's scenario. Then it comes to the concept of strategic decision making. Okay, then it covers the concept of interface of financial policy and strategic decision making. Now, after that, it comes the concept comes of the sustainable growth rate, SGR. That you have noticed that in your recorded lecture, the numericals, even numericals have been covered there. One or two numerical have been covered there. So that is more important. This is a more important topic in this chapter. Of course, other topics are there, but normally these topics are basically related to your, you can say, just like kind of a topic that you have covered at your strategic management paper at your intermediate level. So we are not discussing again and again because you must have a fair idea of these topics as well. Now, when we come to the strategic, after that, our next topic, next chapter in the section 1 is basically risk management. Now, what is risk management? Students, as I told you earlier, there was when we talk about the topic risk management, there was a time when nobody used to pay any attention to that concept of risk management. But with the passage of time, and especially if I talk post COVID, the importance of the concept of risk management has become manifold, because during the COVID there are so many challenges has come to the businesses that they have started realizing that the risk management should be a very important part in our business operation as well as our decision making. And accordingly, sometimes it is said that you must have heard the term of black swan events. So COVID is a kind of a black swan event. It is rarely happens because black swan is neverly seen, but it is rarely seen. So black swan event means it is rarely happened, and since COVID has been really happened, the companies and business has performed many challenges, and one of the very important challenge was the supply chain supply chain management. So after that, the concept of supply chain risk management has gained very important lot of importance. Similarly, it was a time. If you will surprise that because since abhi your initial stage, I am hoping if you have not gone through the overall our syllabus, there is a concept of called futures that we will discuss later on when when the appropriate time will come. But I'm just giving you the very simple hint. It was a COVID time when the oil future has become negative in the history. It is in the first time in the history oil future has become in the negative because due to the lack of storage space, the contracts were selling forward contracts were selling, or you can say standardized forward contracts were selling at discounted value. This rarely happens. So it all these challenges come to the during the COVID. So risk management is very important in today's time, and because companies are, and risk can be of anything. Now risk can be of forex, risk can be of your interest rate. So all these basics have been covered there. Now, since there is a separate chapter, there is a separate paper for risk management. Our in this section of chapter number two, our area of coverage of the risk is basically concerned with the financial risk only. Because in the later chapters, we are covering how to hedge or how to manage this risk. So our concentration is mainly on the financial risk. Now, after that, next chapter comes is security. Now, capital budgeting with risk. You can say it is a advanced capital budgeting. This is my mistake. It is a advanced capital budgeting. Topic is advanced capital budgeting. Now, in this, we have covered like risk analysis in capital budgeting, that how we, because see what is risk is basically uncertainty. So see when at the intermediate level, when we were discussing the topic of capital budgeting, so if you recall that the topic was very simple. They were saying you are investing say today's 1 lakh rupees. Okay, the expected cash flows are 20,000, 30,000, 40,000, blah blah, like this. They were saying like that. Okay, so simply they were saying this will be expected our cash flow, profit, whatever we saying. So you are estimating the future period. You are making estimation for the future period. Now here the problem comes. Future is always uncertain. It may materialize or it may not materialize. So when we incorporate the element of uncertainty, or when we adjust the risk in our cash flows, that is called risk analysis and capital budgeting. So there are various methods have been covered there, like certainty equilibrium method, sensitivity analysis, and scenario analysis are there. Methods are there. Even decision tree are there. So all these techniques are there to make you aware how we manage, how we incorporate the risk in our decision making process. So you see, in our intermediate level, it is an advanced version. Okay. So in addition to that, there is a concept of inflation adjustment in capital budgeting decision. When we talk about the inflation, students, please note that now whenever we make the estimation of cash flows, normally we ignore one thing, and that is inflation. Now today's time, inflation is a prominent almost everywhere. Even is a developed countries like USA could not be save itself from the impact of the inflation. There is inflation in the US as well. So inflation should be the part of our decision making process, and that has been covered in our this chapter also. Then there is a adjusted at present value method. Okay, when we have to see what is the financial impact. Sometimes see what happens when we take up any project. So we just assume that the capital structure will remain the same as in our existing capital structure, but it really happens for the new project. We may have to borrow the more separate money or separate borrowing we have to made. Then in that case, we have to see how we consider the impact of this financing impact. Similarly, there is a topic of replacement cycle. Replacement cycle means when we have to decide when we have to replace our asset. What is the best time of replacement? Because with the passage of time, our maintenance cost is increasing. Okay, with passive maintenance cost of increasing, and our depreciated value is also going down. So we have to balance at what point of time we have to replace our old machines. Okay, this is and even so this is all are covered in this topic. Now, next topic, this section is covered here. Okay, so we can see this section mainly explore the strategic decision making aspect, including sustainable growth. Okay, then another aspect to consider the risk management and decision makings. So more or less, they are concentrated on the same. Okay, student. So this is the area where you can see it explore this area more. Okay, student. Now we are I'm coming to the next section. That is section 2. Okay, student. Now this section starts with security analysis. Now when we talk about security analysis, basically, see security analysis. There you will see the topics of like there are actually I'm just briefing here. First of all, I explain you there are, and if I talk about section 2, because then I will able to link it better. Now these three topics are there. Okay. Now when I talk about the security analysis, basically security analysis it divides divided broadly into two parts. One is fundamental analysis, another is technical analysis. Now fundamental analysis is basically further divided into three things: economy analysis, industry analysis, and company analysis. Now, when we talk about fundamental analysis, when we overall make the analysis based on the fundamentals of the economy, industry, and company. So all these topics have been covered here, and they are covered in briefly in brief. On the other hand, the technical analysis basically covered the charting techniques. Okay, some you can say average analysis. What is the average base exponential average, etc. Then there is a concept of EMH, efficient market hypothesis, which can further be divided into the strong form, semi-strong form, and weak form. So all these have been covered there. Now, when we talk about there is student, please remember one thing. While fundamental analysis is concerned with the long-term perspective, the technical analysis is concerned with the short-term analysis, because in this, the chartist or the analyst make the short-term profit on the short-term basis. स्टूडेंट अगर हम बात करें सिक्योरिटी एनालिसिस टॉपिक की, बेसिकली ये टॉपिक दो पार्ट में डिवाइड होता है आपका, एक तो फंडामेंटल एनालिसिस और एक टेक्निकल एनालिसिस। फंडामेंटल एनालिसिस को हम तीन पार्ट्स में डिवाइड कर सकते हैं: इकोनॉमी एनालिसिस, इंडस्ट्री एनालिसिस एंड कंपनी एनालिसिस। और टेक्निकल एनालिसिस को हम अगर बात करते हैं तो उसमें कुछ चार्टिंग टेक्निक्स हमने कवर करी है, एवरेज एनालिसिस वगैरह कवर किया है, और ईएमएच है, एफिशिएंट मार्केट हाइपोथेसिस। नाउ व्हेन वी टॉक अबाउट द एफिशिएंट मार्केट हाइपोथेसिस, बेसिकली, एंड देयर इज वन मोर थ्योरी हियर आई फॉरगॉट, देयर इज अ रैंडम वॉक थ्योरी इज आल्सो कवर्ड हियर। All these are very interesting concepts. If you read, you will see they are practically happens. Random walk theory means the market has no relationship with the fundamentals. They say, as per this theory, the market move in a randomly manner. Okay. So similarly, but however, EMS says there is a relationship between the fundamentals of a company and with the market share prices. But however, the reflections of the various happenings may be different from one market to another market. While in strong market, even on the basis of insider information, stock prices may be reacting. Okay, semi strong, just say if I any news is coming out, merger of the two companies. So if the market reacts, it is a kind of a semi-strong form. However, if the news of the merger comes and the share price react after say 2 or 3 days, that is based on the past information available. The market is reacting based on the past information available. Then it is called weak form. Okay, student. Now then it comes next the concept of you can say security valuation. When I talk about the topic of valuation, you can we can say that it re-examine your knowledge of the concept of cost of capital. Now, when I talk about the cost of capital, you will recall that yes, sir, I have studied at intermediate level. Okay, so when we talk about the concept of cost of capital, it re-examine your ability, your concept of cost of capital, because in a cost of capital, you must have learned about the basically three type of a cost. Okay, but I will say rather I will say you have studied about the. So I can say okay three type. I'm just covering three types. Then I will cover them. KP preference share, KE equity share, cost of equity share, and K of debt. And overall of this cost of funding is called WAC. That is called weighted average cost of capital or indicated by KO. If you recall that student, you will say yes sir I have studied the same. Now in this section on this security valuation, in this section on security valuation, all these topics have been covered there. Okay, but here the difference is that they in all this cost of capital concept, you have been provided with two things. Okay, like KP, you have been provided with a preference dividend, okay, and the price of share. Of course, you easily calculate KP. Here in the KE, you have been provided with dividend expected, that is D1 or D0, then you apply it with the growth rate and price of the share. So accordingly, you used to use the formula like D1 upon my P0 plus growth rate is equal to KE. This you have done it. But however, now here in this concept, you will be tested, you will be asked to compute P0. That is a what is the justified price? Okay, what is the justified price? Here it is a concept. You will be given with this value, you will be provided with this value, even you will be provided with this value, and you will need to calculate this value. Similarly, in a KD, you you have to calculate YTM. Okay, because you have been given with the coupon rate C. Okay, you have been provided with the coupon rate and you have been provided with the price of the debenture or the bond, and you have to calculate what is the case KD, or KD is called YTM. Okay, now here you will be provided with the YTM, you will be provided with the YTM. Okay, you will have to need to compute the price. So price will be basically you have used their IR method in your intermediate level. Here you will use a simple discounting model. Okay, so all this you will understand once you will go through this topic. But what I want to convey, it basically all the conceptual clarity you have at your intermediate level for this topic will certainly help you to very quickly learn this topic. स्टूडेंट्स आपने जो कॉस्ट ऑफ कैपिटल का टॉपिक अपने इंटरमीडिएट लेवल पे किया होगा, उसका आपको यहाँ पे बहुत उपयोग होगा, क्योंकि इसमें आप वही कंसेप्ट को यूज करेंगे। बस फर्क ये होगा कि वहां पे आपको प्राइसेस दे रखी होती थी और बाकी फैक्टर्स आपको एक उसमें कॉस्ट निकालनी होती थी। इधर आपको कॉस्ट वगैरह सब दे रखा होगा, लेकिन आपको उसकी जस्टिफाइड प्राइस निकालनी होगी, वो आपका सब इसमें कवरेज है। तो इसके हिसाब से आपको बहुत इजी लगेगा अगर आपने उस पे अगर वो क्लैरिटी होगी। Now, next, the topic comes up portfolio management. Now, if I talk about the portfolio management, so student, I think this is a one of the important topic, and I think if I talk about the number of pages, I think in the study material it has a maximum number of pages in the study material. And portfolio management topic is important not only from the point of practical point of view, but it also helps you for making the decision regarding your personal investment as well. So it also helps to make you help in the making the decisions in the business as well, because when I talk about the portfolio, always portfolio implies a diversification. Diversification always reduce the risk. Now, when I talk about the risk that we have covered there in our second number chapter, but when we talk about the risk in context of the portfolio, the two concepts come into the picture. One is systematic risk, another is unsystematic risk. Okay, students. Now, when I talk about the unsystematic risk, that can be diversified. And how can it be diversified? By increasing the number of shares or by diversifying the investment into the various avenues. Because student, normally what happens? And systematic risk affects every investment. Systematic risk means it in fact impacts every investment. Suppose tomorrow there is any war breakout. Okay, so in this scenario, every investment will be affected, whether it is a gold, whether it is your real estate. Every investment is likely to be mostly affected except one or two. It may be possible that one may be untouched, but most of the assets, most of the investment values will be affected. Whereas in the unsystematic risk, with the moving economy, it may be possible that one sector may be affected, other sector may be growing. So by this diversifying our investment or diversifying our investment among the various securities, we tend to increase our profit or growth. Okay, so all these has been covered here. Now I just can also show you by way of diagram. A very beautiful diagram has been given to you in the study material. It says that like that, number of securities, here it is risk. Okay, so it says that as you increase the number of securities, of course the risk is going down, but at this level, below this, even whatever the number you are increasing, risk is not going down. So this risk is called systematic risk. And this risk is called unsystematic risk. Okay, student. So I hope it is clear to you now what exactly is about this systematic risk. Okay, what is the difference between systematic risk and unsystematic risk? So with this and portfolio management, there is other topic as well, like beta. Very important concept has been covered here. Beta. If you recall your intermediate level, I think there is an intermediate level, even a one or two questions, the concept has been covered there also. And in beta, in addition to beta, there is another concept that is called CAPM. Okay, capital asset pricing model, that has also been covered there. Another, there is a concept like market models, Markowitz model. Okay, Markowitz model has been covered here. Then there is arbitrage pricing theory model. All these have been covered here. And there is even one very interesting topic, how the portfolio strategies are like. There can be three strategies: buy and hold strategy, and make constant performance portfolio insurance. So the various portfolio strategies has also been covered. So the coverage of the portfolio is very good in this chapter. Of course, when we talk about this technical analysis, yeah, this is a topic our security analysis. The coverage of this topic is quite limited here, because when we talk about the technical analysis, they can be go very far off. But regarding the coverage of these two topics, portfolio management and this is, so all these has been covered here. Even in when we talk about security valuation, there are some concepts like, when I talk about, so now I link you with, take you with the, link you with the concept of the, uh, with this security valuation. Now when we talk about the, as I discussed with you, systematic risk, unsystematic risk. Now sometime it comes into our mind only the share shares are affected, share prices are affected by the various factors. Generally, it is always come into our mind, bonds are never, they are risk free. But it is not so that even the bonds are impacted by the capital budgeting decisions. So not capital budgeting decision, interest rate decision by the federal or RBI. So whenever there is an increase in the interest rate in the economy, in the market, the value of the bond comes down. So this is even also covered here in the bond valuation. This is security valuation, where this concept is called bond duration. So this topic little bit you will have, once you initially when you are studying, you may have face some problem in bond valuation concept, but once you will go through with this concept of portfolio management, then you will easily comprehend exactly what is about the bond valuation, bond duration, because bond durations lets you know about the bond volatility, and basically bond duration is Macaulay duration concept is there. So all these three chapters are quite interlinked, especially I can say security valuation and portfolio management. So this section, second sections, lets you know about the overall security analysis point kind of a thing, or portfolio management. Broadly, it is a kind of a security type, and even in some MBA courses, these three topics cover your paper: security analysis and portfolio management. They are combinedly called security analysis and portfolio management. So all the topics covered there has been covered here. Now, when I talk about the next topic, next section, it is basically covered, we can say, very important discussion here. And one topic is start with the dynamics, today's dynamic topics of the dynamic world, securitization. Now, when I talk about the securitization, this is concept is bit new, because securitization means the conversion of receivables into liquid assets. See what happens. It's sometime in India the securitization has taken place in the with the 1990s, when I think Citibank, what they have issued. If you talk to your parents, they will let you know the Maruti Suzuki 800 model was the basically first model in the auto industry that created a history, because it was the first car that has been production was on such a scale that within 1 or 2 years, almost maximum, many people have acquired the car. Earlier, purchasing a car was a very distant dream. So what the Citibank has done, because earlier what used to happen, if auto loan, now today's if you want to take an auto loan, so many banks are there that will offer to you auto loans. But there was a time, earlier time, auto loan was not so easily available. It was a Citibank that quite relaxed their norms, offering the loans to the customer to acquire the Maruti car. So they have offered the loan, customer have taken the loan, but once the loans have started, a huge amount of receivable as created in their balance sheet, they want to convert them into liquid. So they have introduced the concept of securitization. By securitization, what happens? The all illiquid assets, that is receivable, are transferred to some vehicle that is called special purpose vehicle, which basically issues the securities against these collateralized instruments in the market, and whatever with interest are coming to it, they are passing on to the in the market in the form of security. So that's why they are called securitized instruments. The next topic comes Mutual funds. Sorry. Now, student, this topic is mutual fund is basically pooling of money. Although this topic is not that much of strategic decision making, but it gives you a very fair idea how the money is pooled and invested because it is a based on a very simple concept. Now, suppose you have 1,000 rupees with you, okay, but you want to purchase a share whose price is 5,000. Okay, as you know that shares are not divisible. Okay, so one you have to buy one share. For this, you have to pay 5,000, but you have don't have 1,000, so 5,000 rupees. You cannot purchase 1/5 of the share. Now, what happens? Five, four another more persons, maybe like you, all are having 1,000, 1,000, 1,000. All another 4% are there. You are there. What you do? You combinedly pool your money and buy the share. Okay. Now, when you buy the share, you issue the units to each one. Okay. Against this share. Because tomorrow, this person may say, I want to back out. I want to come out of this pooling agreement. So they can sell it in the market. Okay. Now, suppose tomorrow the prices moves to 6,000. So what will be the gain to each one? 200, 200, 200. So accordingly, you are getting the benefit of this share, even you have less money, and that concept has been covered in mutual fund. However, in mutual fund, we have various other concepts like net asset value. Okay, there are some theoretical concepts like tracking error, etc. Trading commission. All these has been covered because there are some terms are associated with the mutual fund like exit load, entry load. So all these has been covered there. So all this has been covered here, but it is kind of will give you a fair idea of the what is exactly the mutual fund is there. Then the last topic of the section is derivative analysis and valuation. Now, student, this is a very important topic. Now, when we talk about the derivative, I think some of you have heard, or even I, sometimes students say, sir, even I do the derivative trading. So today, if I ask any child, even they can say you derivative. But do you know that derivative is not solely for the purpose of speculation? Initially, the derivative has been started for the purpose of hedging. Okay, because they have been basically, if we go back to the history, of course, there are some reference that they have they have been somewhere started in the pre-medieval time, like Harappa, etc. There are some reference, but exactly if we talk about the commercial use of derivative, that has somewhere come around in 1970, I think 1970s or somewhere, when Chicago Chicago, or I think CBE, Chicago Board of Commodity Exchange, like CBO, have started their commodity first in a derivative concept have come to the picture by Chicago Commodity Exchange of Commodity Board of India, Board of America maybe. So they have brought out the concept of derivatives for the purpose of hedging. I think it is a CME, not my mistakes. Chicago Mercantile Exchange, they have brought the concept of this derivative. So their purpose was initially hedging, and hedging concept has been more insisted upon in the our study material as well in our syllabus. Now, student, here I would like to I want to give a disclaimer that now the derivative topic has been covered here only for the academic purpose, and you are not advised to indulge yourself into any derivative trading. Okay, please refrain from all these tradings, because once you go through the exam, once you pass the exam, do whatever you want to do. But during this your study, please don't indulge yourself. Of course, when you will see the derivative concept, you will find exciting that, oh, I can earn the money. Okay, but please stay away from that. And so, what is derivative? Now, when we talk about derivatives basically covers three important topics: forward, futures, and options. Now, now, student, these three topics are the basis of derivative. Even there is one more topic, swap. So broadly, these three are covered here in this. Even swaps, little bit has been touched upon, but that will be mainly used in the next chapter, one or two chapters after one or two chapters. Now, when we talk about the derivatives here in this chapter we have covered in a when context of stock market, stocks we can say, or index, and basic knowledge of this derivative concept will also be used for your next chapter, that is foreign exchange exposure and risk management. Okay, then there this topic will also be very important, because there will you understand what is the because where when we see how we can use the concept of derivative in hedging purpose. So we can see here what are the various derivatives and how derivative can be used to hedging. Now hedging the risk, even if you will see find that there is some relationship with the this portfolio management, because the concept in the concept of derivative, even index futures can be used to hedge the portfolio risk. You will see how we can risk our reduce, how we can reduce. So all this has been covered here. So this is a very important topic, theoretical as well as numerical point of view. Now in the next section, that is I think in the section 3 we have covered. Okay, section 2 is there. Next section we have covered. Now section 4, I'm coming to section 4. In section 4, there are three main topics. Then this topic is international. Now this topic has become in today's globalized has become important in today's globalized environment, because as I told you in the beginning, days are the one when the we can say our economy was a closed economy. Okay, normally export import were very limited, and generally import. If we talk about the import, now today if I talk to you, you have seen the many variety of the consumable products, and whenever it comes to our, JC generally said that this product is of China. But when we were very in our earlier time, let's say somewhere in 1990, because if we talk about the globalization that has been started somewhere in the late 90s, because in 1991 the new industrial policy has come, and with the liberalization in 1993, post liberalization, all things, imported goods have start coming, free flow we can say has coming into the Indian market. Because prior to that, if anyone is going to outside India and they are bringing the goods, there is a hefty custom duty. So they are making the uh, imported goods very costly, and domestic production dearer one. But post liberalization, the situation changed, and even all goods are started coming to India. Even with this liberalization, globalization, what happens? Even the export of India has increased manifold, because once, because it is a mutual kind of agreement. Once you open the door for our economy, we will open the door for your economy as well. So with this, the one of the very important concept, where very you can say it is a kind of a strategic decision that has to be started to be taken by the CFOs, and that is called foreign exchange exposure and risk management. Now, what exactly is foreign exchange exposure? I'm just briefly covering here. Of course, the nitty-gritties and you can say in-depth analysis is in this topic. Now, foreign exchange is basically implies. I'm just giving an example. Suppose today you are exporting the goods of rupees, not rupees, because once you are crossing the boundary of your India, so rupee will not be more acceptable. Rather, their own currency will be accepted. But however, in a worldwide, normally dollar is that currency that is accepted worldwide, except there are some countries that are solely using the, not, they are not using the dollar. They have strictly said we want to use the dollar, like Iran, etc. They are not using exactly the dollar. They are normally using the euro or other currency. Even the Iran are trying to enter into a swap agreement, that will be, you understand once you go through the concept of foreign exchange exposure, where they mutually actually say that, okay, we were exporting you oil, you export some goods to us, okay, on the we will exchange in Indian currency. Even there, if you are reading the financial newspaper, then you may have read the news. Even the with the Ukraine, even with the Russia, since there were sanctions were on the Russia, so dollar trading has, dollar exchange has been suspended. So they have entered into agreement that, okay, of course, whatever we are exporting you the petrol, Russia is saying whatever petrol we are exporting to you, you make us the payment in the Indian rupees. Okay, they have get deposited in the Indian rupees, because they say we will use it later on while we are making payment to you. But when we talk about any common currency, then normally dollar comes into our mind. I'm just saying clearly to you. Here, if suppose is today you are exporting the goods worth rupees, worth dollar 1,000, 1 lakh to any another country. Now, normally what happens when you are exporting the goods? Okay, normally it takes some time, because unless and until the goods will be reached to their destination, the other party is not going to make the payment. And since most of the goods are exported through the sea route, normally that takes a time of 1 month, even 15 days, 1 month, or even 2 months also. So normally, and there are other formalities like letter of credit, etc. are there, in the banking formalities are there. So normally payments takes 2 to 3 months. So what happens today? Suppose it is today. I say it is today. This is 3rd May. I am exporting goods of worth dollar 1 lakh to some exporter. Okay, now today suppose my dollar rate is somewhere around is 84. Okay, so I am presuming, of course, now payment will come around, say after 3 months. It will somewhere come around 38. Okay. Now suppose today I say that, okay, I am exporting the goods. After 3 months, the payment will come to me. So I am assuming that after 3 months, 84 lakh rupees will come to me, worth of rupees, because they are converted into Indian rupees, because $1 is equal to 84 rupees. But what happens? It may be possible that by the payment time, payment received in my account, dollar, and I get them converted, this dollar has become 83 rupees. So of course my loss will be of rupees 1 lakh because I will get only 83 lakh against this 84 lakh. So even you in your accounting standard you must have seen this difference in the valuation, the difference in the value. So this 1 lakh loss is basically a kind of a forex loss, and how we hedge it, that has been covered here. Okay, now even sometime what happens, we enter into the forward agreement with the bank that has been discussed in the derivative. So even how we see how we execute or how we what is the execution of the forward contract concept is there. We see how we can use it here. So all this has been covered there. Now next is international financial management. Now international financial management is basically we can say it's a strategic decision making. Again, re-examine your ability or knowledge of capital budgeting decision in international context. This is a prominent topic there. Of course, when we talk about international financial management, so it is a combination of two things. One is international, another is financial management. Okay, so you have studied the topic of financial management at your intermediate level. Okay, now here it's discussion. You will see there is their discussion in context of the international means how we manage the foreign exchange. How means what exactly about the market? Sorry, what about when we say we have to consider the financial management in context of a globalized trading or we globalize our business. So because what happens now when we talk about the capital busting, normally these capital busting decisions are in context of domestic decisions that the company is establishing a one plant there, company is establishing one plant there. So we have discussed the concept there, but now when we talk about the IFM, generally capital busting decisions are made in context of international. International means the company are making investment outside India, outside the boundaries of domestic country. So then there is a lot of challenges are there because see students, I just very give you a very simple example. Now suppose if you are making investment in India, so whatever the cash flow will be generated, of course that will come to your kitty. Now, but if you are making the investment outside India, then problem comes. It is not easy that money will flow to you very easily because every country has their own restriction, own regime. They have a own regime. They have a own restriction that they may not allow the free flow of the capital. Okay, student. So all these has been discussed there in this topic because we can say even sometime what happens, a parent company may have established a subsidiary in the outside India. Okay, now in this case we shall see how we can manage the what exactly the scenario, what is the nitty is all about. Say how they can come. See, they have to see uh, because parent companies cash flows maybe they may estimate something like project cash flows are there, but they may have to check out how we can manage the situation. Because parent company may be thinking otherwise that we are going to make this much of money, but there may be situation may be different. Now next topic comes. So here all this will be covered here, international financial management. Now next topic comes interest rate risk management. Okay, when we talk about interest rate risk management, now when this is a very one of the very important topic. Now what happens? Students, please see. Now there is a kind of a concept of fixed and floating interest. Okay, what is fixed and floating interest? Suppose there are fixed interest means when you say 1 second. Fixed interest means when suppose you are buying them, you are taking a loan. Okay, if you are taking a loan, if you are taking a loan, so suppose if you have borrowed the money at 8% and the duration is say 5 year. So what happens when you have taken the loan? Of course, it will 5 years. The rate of interest will be five, remain 5 year. Whatever the rate of interest is going into the market, you will pay at the 8%. But suppose if you have taken the loan based on the floating rate, then they may say that some benchmark rate will be used, okay, for deciding the rate, because benchmark rate normally keeps on changing, plus some basis point. There is a concept of basis points. Okay, say it says that the loan will be given to you prime lending rate plus 100 basis point or 700 basis point or 200. So say 200 basis point mean. So basis points means BP means 2%, because one basis point is always equal to 1 divided by 100. So it is basically 0.1%. Okay, when we talk about one basis point, so it one 100 basis point means 1%. So 200 basis point means say prime lending rate is today 8%. So you will be given loan at 10%. Now tomorrow if prime lending rate comes to 9%, you will be charged at 11%. Tomorrow it comes 7%, you will be charged 9%. So in this way, you see, with the passage of time, if interest rate are fluctuating, of course, the interest payment is also changing. So in the interest rate risk management, how we overcome this change in the interest rate, in the change in the interest, that is covered in the interest rate risk management. For hedging this interest rate, generally there are two techniques. One is traditional techniques, another is modern techniques. Generally here they are covered are ALM. I think it is a forward is the FRA, that is called forward rate agreement. Another technique I am not recalling it. In a modern technique, that is futures, options, and swap. Okay, and these are further has been divided into cap, floor, collar. So all these techniques have been covered here in the interest rate. So we can see that in this section, the two topics, basically these two topics, I'm just marking in a red ink. Or blue ink. These two topics, interest rate risk management and foreign exchange exposure and risk management, these are basically the hedging techniques. They are mainly meant for the hedging purpose. Whereas this is a kind of a strategic decision making. So this section in 4 we can say it is a kind of a hedging section. Okay, student. Now we are coming to the next section. Okay, now this section is basically now what this section is cover. Sorry, is the fifth section. My mistake. It basically covered the business valuation and the business restructuring, or we can say corporate restructuring. Basically, the topic name is mergers and acquisitions and internal reconstruction. So this topic normally you have seen in your financial reporting paper. So here the merger acquisitions is a very important. Why? Because see student, before I move to merger acquisition, I will take to you the business valuation. Now student, when we talk about the business valuation, I just take back to you your section this, our second section. In a second section, the topic is security valuation. Okay, so valuation means now this once you will come to read this section of a topic chapter business valuation. Now, why valuation has become important? Now, today, uh, many chartered accountants are joining the profession of valuation. Now, it is a very upcoming field and very growing field. Okay, now valuation has become very important in today's time. Why? Because if I talk about the valuation, not only the for the purpose of merger acquisition, that is next topic. It is the valuation has become very important for the settlement of alimony. Okay, now during the any divorce, etc., it is very has become very important. What is the worth of the spouse companies? What number of shares are there, and this much of value is there. So valuation has become now in today's in say every business transaction, the valuation has become their pillar, very important pillar. So here we shall see what are the various methods of the valuations are used. Of course, valuation is a kind of a subjective or thing because we cannot say any perfectly this is the value because valuation is also depend on the many factors. It is a kind of a perception. Okay, a person may say ki if this is worthless, but other may say have a value. For example, I give a very simple example: paintings. Now, a painting worth in rupees $1 million may not be that much of worth of value for any ordinary man. But however, for a art lover, the value may be even more it. Okay, so it depends on each and every perception that how they value the anything. So this value can be of anything. It can be art piece or it can be security. It can be real estate, whatever we hear. But our basically in our this topic of business valuation, we are mainly concerned with the business purpose because uh, here business valuation is discussed because they are very important for your strategic decision making. Because suppose tomorrow you are acquiring, you are become a CFO of a company and your company is going to acquire the another company. So then the question comes, how much worth or how much value this company deserves. So all this has been covered here. Even very we have this time this because since advanced financial management topic is rebranding of the topic of strategic financial management. Even we have included the startup finance. Valuation of startup is also covered here. Okay, valuation of startup is also has been covered here. So all this has been covered here. You will understand what is all about business valuation. Now next in this week, when we talk about the corporate restructuring, it covers merger acquisition. Here, of course, if you see your syllabus, to some extent, uh, it accounting aspect or reporting aspect is covered in your financial reporting paper, and law-based concept or compliances part covers in your, I think set A may cover your paper cover this concept there, self-paced module. Now here we are concerned with the financial evaluation or the merger acquisition is covered here. Okay, student. So this section take you to the nitty-gritties of the merger acquisitions, how we have to make the swap ratios, all this all about. Now, last topic, last section of our syllabus is only one chapter that is called startup finance. Okay, student. Now, when we talk about the startup, now days are the gone when the traditional financing sources were there. Now, if today I talk to any today if I talk to any even a small child about startup, they may give you a lecture. Okay, because now even on a TV, I think there was some Shark Tank program is there. So now today, each and every small child is very even every pupil is covered known the well aware about the concept of startup. But earlier in earlier time, startup was concept was there, but not that was not popular because normally the financiers were used to be a kind of a traditional type of financer. Normally, they used to fund the business in a three form. One is preference share, another is equity, and then it is a loan or a debt. But with the passage of time, the concept has changed. Now, generally, startup financing in a startup, why we call it startup? Because see, when we talk about your financing in a traditional financing, what used to happen? A business is used to start with a sole proprietor. Okay, when they need more fund, they take the partner. Okay, even their business more grow, they convert it into the private limited company. Even more grows business, they issue float a company and float the share. They float a public limited company and issues the share among the public. So this was a process, and this was a very long process. This is a guess. The period was long. By the time they issue the shares to the public, the business has been matured, or business maybe not matured. Business concept, their concept, whatever they are selling, that is selling in the market. Contrary to it, the startup in the startup, the product, there is a basically completely new idea. Okay, there is no market. They have to launch the product. They have to launch the concept. Now, who will be buyer? It is only estimated number. They are only numbers. So now the problem of financing comes. Of course, the traditional sources of finance, financer may not be ready to finance the business. They may say, no, no, we are not in. But in the startup, what happens? If the startups goes well, then certainly the gain will be multifold. There are 100, 300% return, like this kind of a thing. So what happens to finance any idea or in solely new business, new concept? We need a finance, and this startup finance provides the same finance. Now, what is the basis for a financer to gain from the startup? Of course, there is an exit route. Okay, they take the exit route. Suppose today a person has come to you, they say, I am coming out with this idea. After 5 years, my company will be at this level. So Now, if you are interested, you will fund the company, you will fund the startup. After 5 years, if you are confident that the company will be perform well, so of course you can take the exit route by, because now you will be given the shares. So suppose if you are holding 50% of shares, now tomorrow if the company is offloading, the you are taking the exit route, so you can earn a huge amount of money. So that's why startup financier take this risk. He could generally they are the venture capitalist. They take they fund this type of a ventures and they gain from it. So what are the various stages of funding? What are the government of India initiative? All that has been covered here in the startup finance. Now, of course, if I talk about this is generally a kind of a theoretical chapter here. Sometimes students say, sir, what are the topics that are theoretical and numerical? Now, student, I just sharing with you, but of course, I will let you know. If we talk about theoretical chapters, now this is our end of our syllabus. Okay, now quickly, I am just briefing you what are the theoretical and what are the numerical based. Of course, please remember, I will give you some. Please listen to my each and every word very carefully because sometimes student may lose the marks on that account. Now, sometimes some says theoretical. There are some theoretical chapters like chapter number one. Some says chapter number two also. Then your chapter number three is there, but the numericals are there. Chapter number four is numerical based. Chapter five is chapter three is numerical based. Chapter four is quite small theoretical, small practical. Chapter fifth is security valuation, almost numerical. Chapter six is portfolio management. Now generally says chapter seven securitization. They are theoretical. Then they say chapter 9 is your mutual fund, that is mutual fund, that is your numerical base. Then your numeric chapter 9, 9 your derivative, it is numerical based. That is chapter number 10 is your numerical base, 11 numerical base, 12 numerical base. Sometimes they say 13 numerical based almost, and 14 your numerical base, and last in the chapter number 15. So normally students say these are the only theoretical chapters. My request to you, please student, please not understand. Although the other chapters are numerical based, but my request to you, please also refer their theory and be prepared. Be also prepare yourself for the theoretical portion as well, because it gives you a double advantage. First of all, they give you the advantage of clarity of the concept. Somewhere, when you are doing the numerical, you may not be well versed with the numerical, but once you go through the theory and make your small notes, it will help you to give clarity into the what is exactly the concept is. And even in the examination, now when I will in the last I will discuss, but after a break I will discuss with you the examination. What is your examination pattern? So in the examination, even one theory's question is always attached with the your numerical question. Even MCQ based can be a theoretical based. So my request to you, please don't ignore the theory of any chapter. This is a very important thing. Okay, student. Now, when we talk about first, we have covered the syllabus. Now I am coming to what should we refer. Okay, what should we refer for our study? Now, of course, our study material is there. Okay, right now you can refer your April 2023 edition, reprint. October 2003 edition. In addition to that, student, please remember, you can refer RTPs, okay, mock test papers that are now when we talk about the mock test papers, of course, in the end, I will take a one session. I will let you know about the strategy. But please remember, whenever say if you are appearing for November to 24, so my request to you, please refer mock test paper for your revision only previous one. Okay, this should be your previous one. Okay, for your current attempt, whenever mock test comes, don't see it. Try to attempt the mock test paper in examination like condition. Okay. Then then on the website we have a case scenarios. Okay, we have case scenarios, MCQs. Okay, so all these materials now after this attempt, once because this is a May attempt, first attempt is there tomorrow their exam. So even you can refer suggested answers. Okay, as well as new scheme as well as old scheme, whatever is available on the website that you can refer for the same because they will course is almost similar. Okay, except there is addition of one chapter, capital busting, advanced capital busting decision. All the chapters are same, so you can refer even the same. So these are the reference materials that you can use, and this and of course our own classes are there. Okay, you can refer our classes. Hmm. So all this will be help you to prepare yourself for the your paper. Okay, now student, I'm coming to the next thing. What is intellectual level expected from you? Okay, generally we when we talk about there are three levels. So most see in when we talk about the level one, generally these are theoretical questions. Okay, they just need your like writing list out like these verbs are used. Whereas in the case of a level two, it is kind of a some computation basis. Now, when we talk about the level three, they need test your decision making ability, and most of the topics or most of your questions are based on your decision making. So they test your decision making ability. That is normally level three is there, and more important, very important here. Uh, so here you have to make sometimes in a questions like capital budgeting, etc. Uh, you can take the decision. You have to give the decisions generally. They're implied that you have to give some decisions. So always write your answer will be well supported by the some decisions. So because they normally are testing your decision making ability. Now when we talk about the approach to examining the examination structure, I think before break I can cover it. Then I will let us see what is the examination structure. Then I will. Okay, student. Now this first part will be your MCQ based on your case scenarios, and of course, when I will take our last session, of course, I will show you the structure of the question paper, etc. I will discuss in greater detail. For your hint, I am just explaining you because since you are starting your studies, so it is very important how you have to understand how to have to approach the questions. That is very important. Now, this part one will be of 30 marks, and this part will be consist of 70 marks. Okay, out of 100 marks. Okay, the duration will be 3 hours 15 minutes. Out of this, 15 minutes will be reading time. Before giving, you are allowed to answer anything. So this is a kind of a reading time. Of course, in this reading time, the strategies is there that you can see. Okay, and now when we talk about the part one and part two, this section basically covers you the there are case scenarios are there. On the case scenarios, you have to choose the correct option. Now, while this section does not require any presentation, very important to note that. But my advice to you, please do carry out some working for especially for numerical questions. Because if the numerical MCQs are there, so do carry out some rough working, okay, for numerical before marking any option. It is very important because sometimes in a confidence you may say, oh, I can solve it. But please, my request to you, although it does not require any working, but you carry out some working. However, when we talk about the descriptive questions, okay, when we talk about the descriptive questions, okay, so this question will be, this part will be compulsory. And just one, I am adding one more line here. All questions are compulsory will be in this section. In this, there will be a choice. Okay, there will be a choice out of 6 questions. Okay, attempt any five. Okay, out of this, first question is compulsory. Please remember, first question is compulsory. Okay, so overall, this generally they will consist of a 14 marks, and in this, very important, there will be a sections. Okay, the question may containing your three section subsection subpart A, B, C. So it may be possible that it is numerical, it is theoretical, or these are two are numerical, but this is theoretical. So that's why I my request to always student, please don't keep any section or any chapter of any section, because due to this combination of various topic, you can lose the marks unnecessarily. So please don't skip. I am again requesting to you all, don't leave any topic, as all topics are important. So you have to do your study thorough, in a holistic manner. So, and one more important thing, students, when we talk about these descriptive questions, because when you will start studying, you should understand what is exactly required to answer in the question. Okay, they can be theoretical and both are numerical. Okay, in theoretical questions, it is very important to see student answer should be to the point, writing should be readable or legible, and content should be correct. Because sometimes it has been observed that although heading is a okay, students are heading with the okay, but the the description is completely wrong. Okay, okay. So this is some kind of course, I will take some give you some tips in the last class when we talk about the numerical. See, all answers should be duly spotted by adequate working notes. Now, it question comes how much numerical, how much working notes should be there. So please refer our study material because we have given the sufficient number or adequate number of working notes there to for with any numerical question. And very important, follow the instructions given in the question. It is very important. Sometimes you will see there may be some instructions regarding rounding off, etc. So you will see there are some instructions in every question. Sometimes some questions there are instructions. So these questions instructions need to be followed religiously. So overall, these are some things that I discussed because we are starting with your studies. So it is just only a beginning because in the last session I will have a good overall session on the examination strategy. Now before I leave with a break, very important link of this with other paper. Now, student, now AFM paper is also linked with your paper number 6, integrated business solution. So here the the student who are giving second group also, the knowledge of this AFM is also essential for this paper also. So my request to you, please properly go through with this topic so that even you can score the good marks in IBS also. So with this student, we take a small break here. Okay, we will come back. Then I will proceed for the discussion on the two topics that has been covered in our recorded lecture. And then we will open the session for the students' query. अशोक जी, हाँ ब्रेक स्टार्ट कर दिए. covered in the chapter one, because in the recorded lecture you must have gone through. I am just taking you to the question answer section, because of course theoretical question portion you have must be gone through. So just have a hold for a second, then I take you there. One second, students. 1 second, student. I'm just sharing my screen. Okay, student. Now I hope with this question you have seen in your solutions. 1 second, student. 1 second, student. I think there is some problem. Student, in this question, you have seen gone through the chapter, and I think you have gone through the assignment. Now, in this assignment, the first question is basically related to. I think I'm not just 1 second, student. I just check out why there is a problem. Okay. Anyway, I just start discussing. Now, student, you have seen this question number one in our assignment. So here, this question is basically concerned with the sustainable growth rate concept. Now, when we talk about sustainable growth rate, it basically covers. See here, the basically you have been provided with the statement, and you have to compute. First, you have to draw facts and figure have been given to you. Now here you have to draw the income statement for the year. Then you have to calculate its growth rate of earning. So simple calculations was there. Okay, and you have to compute the sustainable growth rate. There, 1 second. Students, just give me 1 second. I just get out what is the problem is there. I just redo it. One second, student. I just re-enter it. Uh, अशोक जी, इसमें स्क्रीन में इशू आ रहा है कुछ। अशोक जी, इसमें ना इशू ये आ रहा है, जैसे मेरे वर्किंग जो है ना, वो डिस्प्ले नहीं हो पा रही। मार्किंग हो रहा है, लेकिन जो मेरा पुराना डिस्प्ले था ना, इसमें वर्किंग जो था, जैसे इसमें तो आ रहा है, इसमें जो फाइल में मैंने जो वर्किंग कर रखा है ना, देखिए, ये वर्किंग नहीं आ रहा नजर इसमें। देखिए साइड में जो है ना वर्किंग, ये तो वर्किंग इसमें कहीं नजर नहीं आ रहा। हाँ, क्या कह रहे हैं? आप मेरे को एक फोन पे,
सर एक बार स्क्रीन शेयर कीजिए आप।
मैंने स्क्रीन शेयर नहीं करी हुई क्या?
नहीं सर।
स्क्रीन ये बार बार अपने आप हो रही है, आई थिंक। वन सेकेंड। ये इसमें ना स्क्रीन में दिक्कत आ रही है कुछ, शेयर में ना वो अनएक्सपेक्टेड हो रहा है।
सर एक बार रिस्टार्ट कर लीजिए उसे।
अच्छा,
यस सर।
ठीक है, मैं देख लेता हूँ अभी, अगर आ जाता है तो। ये नीचे का वर्किंग, नहीं नहीं, स्क्रीन विजिबल है, जैसे नीचे का वर्किंग है ना पुराना किया हुआ, वो नजर नहीं आ रहा। ये
सर
सारा
जब आपने फाइल बंद की होगी ना तो सेव नहीं हुई होगी।
अच्छा अच्छा,
यस सर।
ठीक है, तो एक बार मैं कर लेता हूँ, एक बार लॉग आउट करके ना। 10 सेकेंड, जस्ट स्टूडेंट फॉर सेकेंड, आई जस्ट लीव दिस। 1 सेकेंड स्टूडेंट्स। 1 सेकेंड स्टूडेंट, आई एम जस्ट वर्किंग ऑन दैट। Okay, student, no problem. I just take you to there. Okay, let us see, student. Now, in this question, it was a very good question. Here, you have solved the question at your own. Now, I am just covering one or two points here. Now, student, here, the term effective interest has been given to you. Okay, now the important point here in this is the noting important point here is that regarding effective rate of interest. Reason being is that if you see the securities, there are two securities. Okay, one is 8% debenture. Okay, another bond has been issued at 10%, but they have been issued in 2017 somewhere. Okay, student, now here we are assuming this ending is basically in somewhere in 31st March 2018 because 2000 issuing in 2007 17 indicates that they have been issued some post 1st April 2018. So here very important to note that effective rate we have to take only 8%, and now after that we have to prepare the income statement. Simple income statement has been prepared in this format. I'm not reproducing the answer again because our time left is very less. I'm just giving you a very fair idea. What then we have computed like sales, all figures we have entered here. Operating expenses have been given here. Then EBIT has been given here. Then after that we have deducted interest. That is 8% of 125. Then it is has been 14% has been given. Okay, not sorry 175 because it is a 125 here is this amount and this amount. Okay, this is 14 there. Overall, ultimately next profit after tax comes 31 point. From this we have computed dividend has been paid at the rate of 16.67%. Okay, then amount has been come 5.20. Okay, so retained earning has come 26. Now we have computed the SGR. Okay, for SGR we read ROE into 1 minus dividend, that is retained earning. Okay, so for ROE, student, I need you to draw your attention. Uh, Basically, we have here the use the formula profit after tax upon net worth. Of course, every figure is with us because net worth is with us rupees 100 lakh plus rupees 300 lakh. Okay, rupees 400 lakh has been there. Okay, now after 400 lakhs will be there. ROE is has been calculated profit after tax 31 into 100. Now student, please note this ROE can also be calculated by using the DuPont formula. DuPont formula that has been covered at intermediate level. And as per this the formula, net profit upon the formula is like that: sales into sales upon asset into asset upon equity. Okay, accordingly, this is your net profit ratio. Okay, this is your sales turnover ratio. And this is your equity multiplier. So even this can be used. Okay. Now, after that, the next question, when we discuss about the next question, this question is basically related to your external funding requirement. Now, what exactly is the external funding requirement? Student, please note. Now, when we talk about the concept of SGR, SGR says that how much we can grow with the retained earning, what growth rate we can assume maintain by growth. Now, as per SGR, but sometime what happens, we have to achieve some growth rate. We have to achieve some growth rate. Then we have to decide how much external funding we shall require, because our in SGR normally we are using our internal fund, whereas in case of SGR, we in EFR we are using our external funds. So we have to see, one second, how much external fund is required. So this will be covered. EFR means how much to maintain some growth rate, how much external fund rate, external funding requirement will be required. So this second question, third question, and second, third, and fourth question are basic. Second, third questions are relating to the same question. So in this, we have discussed the formula. What are the our external funding requirement is there? What is and even we have seen in the three scenarios when there is a no fixed, there is no change in fixed asset in proportion to sales and no dividend is declared. The second scenario we have discussed, change in the total asset in proportion to sales and no dividend is declared. Change in the total assets in the proportion of sales and 50% profit is declared as dividend. Okay, so all these has been discussed here. Okay, so you can see and you can easily we have find out there are two methods. One we can use is a common simple method, like we are increasing sales proportionate, we are increasing our assets. There is simple computation method is there. Another approach is there that where we are using the formula. Okay, friends. So first we have started with the started our solution with the preparation of income statement. Okay, so income statement, from income statement EIT has come 1723,905. Okay, then we have start visiting the scenarios, various scenario one. Okay, in scenario one, we have seen that we have used some, since our fixed asset increase is not there, only the increase in the working capital will be there. So we are increasing only by whatever be the retained earning, we have balance retained earning has been used to pay off the debt. So our external funding requirement rather is we can see we have paid some negative external funding requirement is there. EFR is basically minus, and since our existing debt was 30 lakh, 13 lakh 30,000, this much of balance has been left. Okay, in case of scenario two, our EFR result has come minus 84,405, and since our existing debt level is 13 lakh 30,000. Okay. So we can say the balance left is 4 lakh 80,000 595. Then we talk about the scenario 3. Okay, when we talk about scenario 3, in this scenario, our external funding requirement is positive 12,547. Okay, now when we say external funding 500, so here we shall see our existing debt 13 lakh 30,000. So the accordingly the figure comes 13 lakh 42,547. So here this value is positive means this much of external funding required. So students, please note that external funding is not only implies that the debt issue will be there. It also implies that this can be in form of equity. So it means fresh equity can be issued. So accordingly, when we talk about EFR, it consists of two parts. One is issuing the debt or taking. Next is issuing fresh equity. Okay, student. So we can see here that exactly because next question is basically based on the same. Just let me check here. Yes, Mansha. Good morning, beta. Okay. Now I will take up the query. Uh, just have some patience. Okay. Okay, students. So now we are coming to question number 3. Now this question has been adopted from your earlier examination. So when we talk about this question, very important to note here. Here, of course, EIFR is there, but there are some guided by some riders. Okay, there are some guided by some riders. And one important thing here, we have to pay the attention term equity funds. So these equity funds consist of two things: equity capital and retained earning as well. Because if it has been mentioned only equity capital, then answer will be bit different. Okay, so accordingly, when we have start solving the question, when we have start solving the question, in the first part we have computed EFR. Okay, so here basically we have solved simply using whatever we then. I'm just quickly reproducing the answer here so that our clarity will be there. Profit margin at the rate of 4%. True. Then dividend payout. then dividend payout. Okay, so left, whatever is the left, that is plowback, or we can say it is a retained earning. Okay, now it says how much additional fund we are required. Now, when we talk about additional fund, it's 14,000 minus 2,000 into 0.2. Now, student, please note 14,000 means the total of balance sheet. Okay, a part has been financed by payables and provisions, because it is always assumed that a portion of current asset is financed by the current liabilities, and it is our current liabilities, and here all these items are current assets. So a part of course that is financed by the same. So we can say that because this will automatically increase by 20%, it will automatically increase by 20% if nothing has been mentioned. So of course our increase will be, additional funding requirement will be 2000. Our this much of fund we require, this much we are meeting from our own sources, so balance will be met out from AFR, that is external funding requirement. Now when we talk about the external funding requirement, we have some riders with us. Okay, so these are the riders, I'm not reproducing here, these are the riders are there. Okay, so first we compute riders are there, conditions are there. Now in this, after this we start solving the question. Main part, it comes here. Amount to be raised from short-term loans. So we have seen that we have to meet some conditions, because we have to see conditions that our short-term loans, payables and provision should be in the ratio of 4:3, that is of the sales. Okay, accordingly, what we do, we carry out the proportion. So our short-term loans and provisions and payables should be 5,400 lakhs. Okay, now less. Okay, now what are this amount? This amount is here. This has been increased by 2,000. This will be increased 2,200 to 2,400. Short-term loan is 3,000. So accordingly, the amount comes 2,400 plus 3,000. It comes. So it is meeting the condition. So we can not raise any amount from this. Okay. Then third comes. The next part comes. Second is the amount to be raised from long-term loans. New fixed asset. Okay, now here we have assumed that our fixed asset will be increased. That has been assumed because only that generally, if nothing has been mentioned, it will always assume that fixed asset will also be increased. Okay, 4,800. Sorry, 1 second. So this much of amount to be raised from long-term loans. Now let us see whether it is meeting our criteria. Because we have mentioned here our condition that new long term should be ratio is to 1 is to 1.5. Okay, so of course it is meeting the criteria. So now we are moving to the third part, amount to be raised from equity funds. Okay, so it is a 2 to 5 lakh. Overall, this has to be amount from raised to be 2 to 5 lakh because we have computed here. This amount we have computed that has been used here, less amount to be raised from long-term loan, short-term loan, and provision. This is nil. Amount to be raised from long-term loans, that is 800. The balance will be left 14. Thus, this much of amount we have to raise from equity funds. Now, out of this equity funds, student, please note that, okay, 144 is part of retained earning. So balance 13,12000 will be equity capital. Okay, student. So there is another alternative approach we have discussed, but this approach is basically from the suggested answer point of view, and that's why I have covered here. Alternative approach, you can refer the solution from uh, our previous lecture. Now I am coming to the last question of this assignment. Bond refunding decision. Now, student, please note that bond refunding decision, when I was discussing with you interest rate risk management, I was discussing the concept of floating rate. Okay, so floating rate means when the interest is keeps on changing, and that is used for our loan basis. Now, student, what happens now if you read this question? That this company has issued the 10% callable bonds. Now, question comes: callable bonds means when you will refer the topic of derivatives, then you will understand this is called call option. In a callable bonds means the company can call the bonds for redemption anytime prior to its maturity. Okay, callable bond means this is a, so here they are issued the callable bonds 10% means whenever they will see our, because they are paying the interest at the rate of 10%. So of course they will see whenever, say tomorrow the rate of interest come 12%, so they will keep silent, they will keep mum, they will not do call the bonds. But once the bonds values are coming down, rate of interest are coming down, so they will naturally they will start calling the bonds. Now for this they will need to pay some premium, that is over and above the value face value. And in the, then it says since for the last some year due to falling interest rate the market In the market, the company can issue 10 years bond with the same feature, same amount, 8% per annum. Now, here the 10 years has been left. Company needs this fund for the 10 years. So what's the option left with the company? They can opt for this option. They can issue the new debentures or new bonds at a 8% per annum, and they will refund this 10% bonds with a premium of 7%. Okay. For overall, of course, there will be some payment will be required. 60 lakh will be the amount will be there. Okay. So this which will be the this is a case. So here this basically bond refunding decision, we can say it is a kind of a capital budgeting decision. Why? Because here in the solution you will see, first we start with solution with the initial outlay. Okay, which includes our two things. One is call premium. Okay, so this is coming 140 lakh. Okay, then flotation cost. 1 second. Yes, yes. I'm just explaining it. Now, one student has said, sir, why in the initial outlay in the solution we have seen, we have not covered the payment part. Okay, because we are making issuing, we are refunding the decision. Now, student, please note, very good question is there. Now here, 20 crore will not come into the picture at all because see, very good question has been asked by this. I'm just completing it. Then I'm just telling you. Overall, it means we are paying the 2 crore is our initial outlay. Now, student, please note from the when we are refunding this 8%, our negative is 2 crore. However, when we are issuing this 10% debenture bond, of course, our cash flow is positive. So whatever the amount we are uh, paying, these are coming from our newly floated debenture or bonds. So accordingly, this will not come into the picture here at all, initial outlay. That's why it's very important to note. Sometimes students commit the mistake and they got the confused. So student, please note that because we are generally in this type of a questions, same amount of bonds or debentures are prematurely redeemed, and same amount of new debentures are or bonds are issued. Okay. Now then we next part we consider the annual saving. Okay. Now annual saving. So it means we are making our old interest payment, but so we are pay, saving old interest payment, or we can show by way of saving. Both ways will be acceptable. Earlier we are paying 2 crore rupees each month, each year for interest. Now new interest burden. So overall saving of is 40 lakh. Okay, then we are coming to the NPV simple. We can say it is a kind of a uh, annual cash flows kind of a thing. Or here it is our initial outlay. So we, as per capital busting decisions, simple we say NPV of refunding decision. Okay. Now how we are computed here? Of course, for the our 40 lakh is saving into, now here student please note that we shall take the total of these all, okay, and total comes 6.709 lakh. Now student, my request to you here is very important in this regard. Please see here the decimal points are three, up to three decimal points are there. Okay, so please my request to you, please don't round it off to two decimal point, or don't extend it to the four decimal point. Whatever figure has been given here in the question, please follow the instruction religiously. These are some small tips. Generally, it may lead to losing your marks. Okay, initial outlay. Okay, one initial outlay is 20 lakh, 2 crore. Sorry. Overall, we can see here our overall saving is of 68 lakh 36,000. So of course we should refund also. This is a kind of a bond refunding is here. Now there is one more. Of course, I have solved a very simple case here. Moreover, a overall question that we can be covered later on. That is has been covered in chapter number. I think it is a five. Three, four, five. This has been covered in chapter 5 also. There is an in the end. There is last question is also on the bond refunding decision. So this was the overall about the topic, your assignment for the working one. Now I am coming to the risk management topic. There is, we have discussed the assignment also there. So I am just quickly assignment there. Then I will open the session for the student queries. One second, student. I'm just 1 second, student. Just sharing with you. One second, student. I'm just discussing with you. Now I'm sharing my screen with you. Okay, student. Now I hope this is visible to you. Earlier there was some issue, I think. Now, student, please see here. In this assignment, we have covered the concept of various types of concept one or two numerical we have covered here. Here we have considered the concept of value at risk. Now, when we talk about the value at risk, generally the value at risk it is assumed that the data is normally the prices are normally distributed there. So here what happens, we generally it is based on a normal curve. So if we talk about this question, it says Neil holds 10 crore shares of XY Limited whose market price standard deviation is 2% per day. Assuming 252 trading days in a year, determine the maximum loss over a period of one trading day and 10 trading day with 99% confidence. Now here the 99% confidence is basically, we can say 99% kind of a probability, and it can also be used here that 99% confidence means here we are somewhere lying this here. Okay, so accordingly, the multiple or the variable that is multiplied that can be multiplied with the standard deviation is 2.33, and this variable normally generate from this table. Now, if there is a mention here cumulative area under standard normal curve distribution, you see here, students, 99 has been come from 99. It is the value covered is in area is 0.99.0. So it means it implies it is 99%, and the variable multiply will be 2.33, and accordingly, तो स्टूडेंट आप ये देख सकते हैं कि ये जब हम इसको कैसे निकाला जाता है। सिमिलरली अगर हम 95% की बात करेंगे, generally if you talk about 95%, so somewhere 95% will be lie here. Okay, student. So accordingly, this variable will be, so we can determine different level of confidence according to this table. So here, this has been given for a maximum loss over a period of one trading days and 10 trading days with the 99%. We have to assume. Okay, now assume share prices are normally distributed for 19 level and the equivalent jet score for the normal term has been given. So simply, we have been given the volatility. Volatility means standard deviation. When we will discuss the topic of portfolio management, then this term will be more clear to you, because volatility generally computed by the standard deviation. So here our standard deviation is given like, 1 second. Standard deviation has been given about 2% per day. So accordingly, our daily volatility comes rupees 20 lakh for the each day, one single day. Okay, now we assume, now we compute how much maximum loss with the 99% confidence level that will be there. Okay, so this will be 20 lakh into 2.33. Okay, because we have multiplied with this variable. So the this much of amount, this we can say that there are, or it can be reverse uh, discuss that there is 1% probability that the amount of loss on the portfolio will increase more by will be increase will be more than 46.6 lakh. So basically, we can say that if we deduct the 100 confidence level from 100, it is the level of probability, or we can say it is a probability of that loss. Now, expected maximum loss for 10 trading days. Now, here we have been provided the value with the, we are concerned with the one trading day. So, same we can use here for the 10 trading days, multiplying the same value with the square root of the 10. Okay, student. So, this will help us. We have computed comparison. Now, it says standard deviation of the portfolio for the 10 days. So simply we are multiplying 220 lakh into this, or we can say like this, if we consider it from the variance point of view. So variance point of view, 20 square into 10. Okay, whatever with this, it will come 400, 4,000. So even we can compute the straight amount here. It will be the same answer. Okay, student. So this was the first question. Now I am coming to the second question. Then I will come to the third question. Okay, second question is there very simple. It says the company, one second, I think I received one query. Yes, I will take it up. Just 2 minutes wait, student. Now it says XY ABC is considering project X, which is normally distributed, and mean of return is 200 crore with a standard deviation 160 crore. In case ABC losses on a project more than 1 crore, there will be a financial difficulty to determine the probability of the company. So here it means we have to compute the probability and we have to see where the value will be the lies. Now, always in the middle of the normal curve, mean value will be there. Okay, now we have to take -1, of course, means loss of 1 crore. So minus figure will be there. So we have to compute that what is the probability that there will be loss. So we have to compute this area and we have to deduct this is from the 1 if it is in the point form and from 100 if it is in the percentage form. Okay, so we have computed it is a 96.9 96.9. So 96.9. So but we have followed the formula. We have followed the first, we have computed the variable x, that is -1 standard deviation sorry, a mean upon my standard deviation. So this value we have located in the table. Okay, and when we have start located in the table, you see that we have used the interpolation there. Okay, by using the interpolation there, we have computed the this value, these two values we have computed interpolation. So whatever the value we are getting, we have multiplied the same. Okay, so 1 point, this was our Z score 1.87, and we have computed this value. So this value has come 0.9696. We deduct this from this value, so our probability is 3.04. So it was a very simple question, very basic question to give you an idea how from the normal curve we compute the probabilities. Now in the last question of this assignment, this question is from your earlier examination. The amount is lying in our bank account. Somewhat this amount is lying in bank account, 7 lakh, 1 lakh has been kept there minimum. So ultimately available is amount is 6,99,000. Now the question says like that. The investor desires to make a maximum possible investment where the value of risk should not exceed the balance lying in the bank account. The standard deviation of the market price is 1.5 per day. The required confidence level is 99%. Okay, student. So now here he requires the 99% for the 1 day, for the 4 days. For the 1 day, we can compute it by dividing this value by square root of 4. Okay, so this value comes this much. Okay, so they can bear only this much of loss. And for the 99%, the factor is Z multiple is 2.33. Accordingly, we can say, see, when we have computing here, just I take you there, then it will get clear to you. We have computed the maximum level of loss standard deviation into Z multiple. Now here we have been available with the figure of maximum loss. Okay, our maximum loss we can afford is 6, this much of amount we can operate, this much of amount we can say absorb the loss, loss we can bear. Accordingly we divide it by the multiple, so we can compute here volatility, that means standard deviation. Okay, and now since it says that the standard deviation of the price of security 1.5% per day, so accordingly volatility standard deviation divided by 1.5. So accordingly, this much of investment we can compute. So student, please note that in this overall question, the main important point is per day, because this per day calculation will take us to the what is the maximum possible investment that we can make, so that we can bear the loss of whatever the amount lying in our account. So with this, I hope the two assignments must be clear to you and topic must be clear to you. Now I think it is a time to open the forum for the student. Ashok ji, there is one query was a student of, I think, but there was one query regarding sir table. It was saying sir whether table will be provided in the examination. Student, please see, normally the questions value of the Z will be given to you in the question itself. Otherwise, it is quite bit easy to remember for you, because normally 95% confidence level is come, the level is 1.65, and 99% for confidence level the variable. So these are just easy to cram, even they will be provided in the examination. In case they do not provide in examination, please don't worry, you can leave the answer as it is there. Now Ashokji, please leave the open the session for students. Open the session for students को open कर दीजिए. Student, if you have any query, so please raise your hand. Okay, one student is asking, sir, which topic is more important and how much time we should devote to this other topic? Okay, okay. Now, student, please see here. It is each one's option. Because it is each one's level, how much topic they need to devote, they can devote their level of understanding. But my request to you, as to I told you, there is no topic is less important, no topic is more important. All topics are equally important, and even during our discussion, you have seen that some concept may be used in another topic also. Like when I talking about the concept of beta, it is equally using in other chapter as well. So it is very important that you should be thorough with all the topics, so that they can be used interchangeably. Like derivative concept is using there in the foreign exchange exposure risk management. So all you can see that they are somewhere interlinked. Overall, there is a holistic approach. So that you have to see. Okay, 1 second. There is one query more. Mm. Their student is saying, sir, is the for security analysis topic is charting tech. Okay, student, please see that for the security analysis topic, of course, charting techniques are important, but here we have kept the coverage our limited, because see what happens. Charting techniques are very wide topic, and it involves a lot of type of charts are there. However, the possibility of coverage of each and every chart is quite not possible here. So our coverage has been limited here. Only you need to have some understanding what are the various charts, simple charts like Japanese candlestick chart or point and figure chart. Only that basic things we have covered here. So you are clear with them. And of course, mutual fund topics are there. Mutual fund, of course, we have shown what is a net asset. Some terms are, or you can say glossary are associated with the mutual fund. So all these have been covered in very limited manner so that you can understand the basics. Of course, when you will come into the real world and you will start using them practically, then you will exactly know how they can use practically. But here we have kept their coverage is limited. And so far as a topic of derivative, of course, as I told you in the beginning, please don't indulge yourself in the speculative trading, etc. Just really merely here the purpose is academic only, and you concentrate yourself on your academic point of view. Okay, and very important, whenever you attempt the derivative questions, etc. There is one I just concept I want to discuss with you. Maybe you will find it. You may have used it. Yeah, there is one concept is exponential value that you will use further also. Generally, it is called exponential e raised to power say 0, 0.1. Okay, or I say it is e raised to power 0.10. Student, I just tell you what is exponential value. Exponential value means daily compounding. It is called daily compounding. Student, please note that when in the topic of financial management, the I think it is a second topic in a financial management. Okay, where the concept of time value of money has been covered. In a time value of money, where there we see the concept of compounding. Say if 10% rate of interest is there, okay, and so and 100 rupees has been invested. Okay, accordingly, after 1 year, the amount will come 101. Now, if I say the interest will be compounded after 6 months or semi-annually. Okay, so what we do? We do like that. Okay, two is divided here and two is put up there. So accordingly, the answer comes. Okay, student. Now this we see that there is an addition of 25 paisa here because of this two-time compounding. Similarly, if I say it is compounded quarterly, okay, then what will be the answer? Okay, so we can see that with the increasing the number of compounding, our our value is increasing. So similarly, when we say that it is a daily compounding is denoted by this value. Okay, student, I am not. I think the value is not maybe available with me. I am just checking it on my Excel. Generally, which is value is given in the question. If in the question the value has been given to you, only then use it. Otherwise, you can use a simple compounding. Okay, student. Now let us. There is one more query. I'm just replying the same. Student is saying, sir, what is the exact manner of the presentation of answer? Student, please note that exactly there are no such criteria. We can say that this is a perfect method. However, my opinion, and even it is, I have seen it from the my previous working in the exam in the board of studies. Normally, reasonable working notes are required. You are not supposed to write 2 + 2 is equal to 4. However, if you have arrived on at some figure and you are taking that decision on that basis, so of course you need to show how you have arrived at this figure. This is the main point of the presentation, and you should take care because presentation matters a lot. And one more important point that we are trying to discuss with you, there is always a stepwise marking. Okay, and in this context, I will refer you. there are two articles that has been covered in recent student journal, April 2024 issue and the May 2024 issue. In this, we have basically covered what is the syllabus, etc., and what are the various points that you need to cover. Because we have given some tips also. What are the important points you need to take care? And in this issue, we have mentioned how exactly you can win in the examination. Of course, first you refer this along with your study. You can also refer this issue from the chapter. This is on the page number 25 of the April 2025 issue, 25 and 26. And there is another issue, and this is in the May 2024 issue. This is on the 24 and 25. So we have here covered what are the basic strategies and what are the various points that need to be take care so that you can score the good marks in your examination. So, okay, students, with this, we are coming to the end of the session. Ashok जी, कोई query तो नहीं है ना बच्चों की अभी? Let me check my chat box if there is any query.
नो सर।
ठीक है. Okay, student, with this, we are coming to the end of the session. Now, before going section, I'm just, if you have any query, students, so you can refer your, please send your query through the Buyers mobile app, or you can email to us sfm-final@ICAI.in, or you can even directly contact us at this number. Sorry. 0120 is STD code, but this is our number. This is directly will be picked up by me or my assistant. So, student, with this, we come to the end of this today's session. In next section, we shall take up the reviewer session for the next chapter. Thank you. Have a nice day, and thanks for patience listening again. And thank you, IT team, for your cooperation. Thanks a lot. Thanks a lot, everyone. Yes, session over. You too.